King
Yes.
Solomon?
Now we hear you.
Is it
Great.
King?
This is the third and final session for personal finance. We started off with financial planning, and the reason why is I call that the prerequisite to investing. And if we listen to that famous philosopher Yogi, the reason is if you don't know where you're going, you won't get there. And one of the importance of financial planning is to understand what trade-offs you have, what your goals are, when they come due. I also have a definition of investing, but what I do is not really investing because I don't put any money into any company that's going to make any difference at all. So what I do is wealth building and wealth maintenance. The closest thing to investing would be a question I think Romana asked me, I think it was last week, is investing in startups. And I certainly wouldn't do that because investing in startups to me is like gambling. And I'll have part of a slide that talks to that. Finally, I have a picture of King Solomon, and near the end of today's talks, I'm going to give you King Solomon's tips on investing in money management. Caveats again, you've seen this twice. I'm not giving financial advice to anybody specifically. There's no cookie cutter answers. Everyone is unique. Past performance is not a guarantee of future. This is a repeat slide to remind you, when you invest, stocks have a much higher return than bonds, which have a much higher return than short-term investments. But on the other hand, stocks are more volatile. So in the short term, where you're talking about 1 year, maybe 5 years or less, you want to be in short-term investments, 5 to 10 years, a mix of stocks and bonds, over 10 years, more stocks than bonds, and no short-term investments at all. When you get to 30, 40 years, you almost want to be fully in stocks. And that's one of the things that financial planning does. It gives you time frames for things. I talked about last week 2 parts of the stool, the most important things to investing, which is asset allocation and having enough stocks, not in 1 or 2, but in many, called diversification. Same with bonds. You'd like to have a lot of stocks or a lot of bonds. The third stool is asset location. And I'll tell you what I mean by that. There's generally 3 places you could put money. You could put money in taxable accounts, you could put money in tax deferred accounts, or you could put money in tax-free accounts like Roth IRAs, 529 accounts for education. And where you put your money matters. And the reason for it is the tax code. The tax code is very friendly to dividends for stocks. So if you invest in stocks in a taxable account, it's taxed at a lower rate than you normally pay. When you invest money in a tax deferred account, whether it's stocks or bonds, you don't get that break. So after you've gone through and allocated your money correctly between stocks, bonds, and other assets that I talked about last week, now you have to place them. So the first place to place them is take the least tax efficient funds like bonds and put them in tax deferred accounts. You want to take the most tax efficient funds, which you could place anywhere, but it's best to place those in taxable accounts. And that's because you get that break that personally I think it's unfair. People who work for a living, your wages are fully taxed at the highest rates you pay, but you get a break on investments. And what I do is not investing at all. I'm buying like the S&P 500 or the total stock market. I don't think I'm really taking any risks in investing in any companies. There's a bunch of principles when you go through that. And I'll go through some of these. The lower the tax efficiency, as I said, the more likely the asset should be in a tax protected account. Like a IRA, a 401k, a 403, a TSP if you're a government worker. The higher the expected return, the more likely the asset should be in a tax protected account as well. The more volatile the investment, like small cap funds, the more likely it is better in taxable. The more likely you are to avoid paying capital gains taxes, the more likely you should put capital gain assets in taxable, along with all other stocks. If you have an RMD problem, that means required minimum distribution from a tax deferred account, try and put more money in a tax-free account and try and do that earlier than later, because when it comes time for Medicare, there's different cliffs and you don't want to be earning too much money and pay extra Medicare Part B and Part D taxes, if you will. I talked about annuities, I think, in the first session, and there's some benefits of having annuities in your asset allocation. Firstly, it minimizes the risk of income decrease in a market downturn. It reduces the odds you will run out of money in retirement because it will pay you for as long as you live or as long as you and somebody else, like your spouse, will live. It can maximize lifetime income. It allows you more aggressive investing in other areas because some people think of it as a bond. So you could invest more money in stocks. And best of all, you defer taxes on your growing money. And remember, as one of the most powerful forces in the universe is compounding your interest. But there is a cost. Annuities don't come cheap. You have to shop around. In total, the average fee on variable annuities are about 2.3% of the contract value. It could exceed 3%. I have an annuity that I bought years ago that's no longer selling from Vanguard, where the fees are about 0.25%. A fixed annuity will have much lower costs than a variable or indexed annuities, but it's more like a bond and won't pay as much as well. There's many riders that you could buy for annuities, and there's charges for each of those as well. Um, a slide on beware what a salesman is trying to sell you. First of all, if we look at Bernie Madoff, if it's too good to be true, it probably is. A financial advisor once tried to sell me a variable annuity that he said would never have a negative return for any year that I had it. Of course, that was one of the riders that cost you money. He showed me how a sample portfolio performed over 20 years. The problem with all this is, first of all, he gave me a perspective that had lower fees than what was currently available. It was old. I also needed a financial dictionary to understand it. I would have to invest in low risk, adverse investments in order to get the downside protection that he was promising me. There was a lot of extra fees for this. The investments he picked as my example was the most favorable portfolio he could pick over the last 20 years. So, hindsight is everything. And finally, there was two sets of books, one with the downside protection and one without. And when the one without went to zero, you would have to annuitize, and the annuity rates that it was paying out was exceptionally poor. I do find most annuities to be poor investments. There are exceptions. Certainly, pensions are annuities. Social Security is a type of annuity. I get a pension from the government. My pension check that I get every month is not called a pension. It's called an annuity check. So some of them are very good. Who should you take advice from when managing your assets by yourself? A quote from Bernard Baruch. He was a famous Jewish investor. He was an advisor to 6 different presidents. The business school at the college I went to was named after Baruch. It was called the Baruch Business School. And his quote, beware of barbers, beauticians, waiters, or anyone else bringing gifts of inside information or tips. And very important, before you buy a security, find out everything you can about the company, its management, competitors, its earnings, its possibilities for growth. And that would be another reason why I would never be a startup. I just don't have those kind of smarts. As a matter of fact, I don't have the smarts to buy any particular stock. And that's why I like to buy the whole market. Mutual funds, hedge funds, pension funds, index funds, and the like are the biggest institutional investors, and they make most of the decisions on behalf of their shareholders. They do most of the trading. About 70% of market tradings in stocks are made by big institutional investors. And another reason why I like to buy index funds or ETFs is because a lot of these big time investors, institutions, have looked at that, have looked at all the funds, and I think I'm getting the best advice from the most people, and I like buying things at a fair value. We saw this slide before last time, but I want to go over it again. It's important. If you look at the S&P 500 over 1 year, it beats about 65% of all other funds. Over 10 years, about 85%. Over 15 years, close to 92%. Over 30 years, it beats 98% of the funds. So how can you do very much better? The only way I figured to do better is I mix the S&P 500 with some small stocks as well, from something called the total stock market fund, or investing in the Russell 3000 fund. And those funds invest in anywhere between 3,000 and 5,000 funds. The S&P 500 makes up about 80 of all those other funds. Again, in 2008, Warren Buffett, a very famous investor, bet a hedge fund manager, any hedge fund manager, that if he invested in the S&P 500 over a 10-year period, he would beat any hedge fund manager's funds. Of course, he won the bet. He won $1 million, which he donated to charity. He also said if he should die, his wife should invest 90% of his wife's funds in the S&P 500 rather than his own Berkshire Hathaway fund. Those are tremendous numbers. And just to go you what percentage means, Sandy Koufax, one of my baseball heroes, had a 65% win percentage over his career. The best baseball team over the last decade only won about 54% of their games. Why does the S&P 500 do so much better than other funds or portfolios or active managers? The returns earned by active managers seldom outpace the S&P 500, as we saw in the previous slide. Part of the reason why is the failure of active fund managers was a result of costs that they incurred. The average fund manager is average, but only before all those funds' operating expenses, advisory fees, turnover costs, sales loads, etc. After all those costs, active managers become losers' game. Also, don't discount the tax burden of active management. If a fund manager is buying and selling stocks, every time he does that, you're going to pay taxes on whatever gain there is. So I believe in buying stocks or bonds and holding it for the long time. Same thing with insurance companies. If you buy an annuity, if you buy a whole life insurance policy, if you buy a term life insurance policy, those are only issued by insurance companies. And there's generally two types of policies, whether it's an annuity or whole life or term life. There's variable insurance policies, and they invest about 80% of their funds in the stock market. If you buy a fixed policy, they're buying about 75% in the bond market and most of the rest in stocks. And why do I think those are not usually very good investments? Because you're paying for the shareholders of the insurance company you're paying for the building that they own, you're paying for the large salary of the CEO, you're paying for the salesman, you're paying for the HR department and all the analysts they have. So by the time you get through, you're usually much better off investing on your own. Another slide that I showed you the first week was on retirement planning. And there was a famous study done in 1994, and it's called the 4% rule. For those who retire at age 65, we figure they have 30 years to go, and the best portfolio is about 60-40. And at the time of the study, if you took out % a year and increased it every year for inflation, you'd never run out of money. That's been updated in later studies. It's called the 4.5% rule now. Of course, you'll find other studies that tell you it's 3.5%, others 5%. If you retire at a later age, you'll start taking out money from your investments. If you only have about 20 years, you're at about 50-50, and you could take out about 5% a year and increase it for inflation every year. There's some problems with that, and I'll go over that in the next slide. If you go through that, here's almost like a Monte Carlo analysis. So here's 64 different runs of backtesting data from 1955 to 2019. And you could see each of these colors represents a different run. And here we've taken out 4% a year. We've increased by inflation every year. We started with $1 million, and about 94% of the time, we didn't run out of money. About 6% of the time, we did. So it wasn't without problems, but on the other hand, there was many times where we wound up with way more money than we started with. So in a lot of times, this was very conservative. As a matter of fact, we wound up with an average after 30 years of about $2 million, starting with $1, and it went for all the way up to about $4.5 million. So what I would kind of recommend is you might start off with 4 or 5% and see how it's going the first few years. If it's going down, you may want to take out less money. If it's going up, you may want to take out more. And that's why I use a lot of these things, not as rules, but as guidance. Any questions so far? Don't be shy.
Hey, Ira, it's Kathleen. I just want to make sure I understood that. You're saying take out 4% of your retirement funds per year? Is that what you're saying?
Yes, you can take out 4%.
Okay, and how does that work with the required minimum distribution?
Part of that could come out of required minimum distribution. Some of it could come out of taxable funds.
Oh, I see. Okay.
So it's wherever you have your money. Of course, you better take it out of required minimum distribution, or else there's a 50% penalty. It's terrible. John Bogle, one of my heroes, and the founder of Vanguard, his investment philosophy, and he's probably made more multimillionaires than anybody I could possibly think of. Select low-cost funds. Consider carefully the added cost of advice. And that's why you have to think of, do you want to do it yourself or do you want to hire a financial advisor? Do not overrate past fund performance. So you'll find plenty of financial magazines who'll tell you what wonderful stock pickers there were in the last year or last few years. A quote from Niels Bohr, another famous Nobel Prize winner, Jew, in physics. Prediction is very difficult, especially if it's about the future. Use past performance to determine consistency and risk, but be careful. Same thing when you look at magazines, beware of stars and star ratings for mutual fund managers. Beware of asset size. Don't own too many funds. You'll never be able to keep track of it, or they may be duplicate. Buy your fund portfolio and hold it. Another quote from Paul Samuelson, the first American and first Jew to win the Nobel Prize in economics. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That's not how you should invest. Bogleheads. Bogleheads is a term to honor the Vanguard founder, and it's a group of investors. There's a great website that they have. They have a book that I'll go over a little later. And they'll start off, develop a workable plan, have a financial plan, have your goals, make sure you could reach your goals, trade off your goals, invest early and often, never bear too much or too little risk. If you have too little risk, like buying CDs, they pay so little. If you put 100% of your money in stocks, especially at an old age when the market could go down, that's not good as well. Never try and time the market. Just invest early and often. Use index funds when possible. I'd like to add to that, use exchange traded funds as well, which have lower fees often than even index funds. Diversify. Don't buy single stocks. As a matter of fact, invest with your brain, not with your heart. A lot of people from this area will invest in either Pfizer or General Dynamics because they're local companies. But even people here, or even people who work for the companies, know very little about what's going on. The big institutions have looked at all these stocks and have placed them at the right cost. Minimize taxes. And that's what I meant by asset location. Put stocks in taxable funds, bonds in tax-deferred funds, put anything in tax-free funds. KISS, keep it simple. Stay the course. Just from some studies, the average passive fund expense ratio is about 0.13%. The average fees for an active fund is about 0.66%. But besides that big difference of over 0.5%, You're also going to pay more taxes. You're going to pay an advisor, an asset under management fee, anywhere from 0.5% to 1.5%. When I talked about hedge funds before, if you look around at hedge fund managers, there's plenty of hedge fund managers who are billionaires. The people who are investing with them don't make out well. The reason for that, most hedge funds charge a fee of 2% assets under management. And on top of that, will also charge 20% of any profit that they make. So most people who are investing with hedge funds managers are losing money compared to what they could do elsewhere. If you look at the average investor, he's earned about 7.8% over 25 years, investing on stocks compared to about 10% if you just bought the S&P 500. Part of the culprit, poor market timing, with the typical investor holding funds for an average of 4.5 years. So it's generally better to hold on to your funds. Of course, when you invest money in taxable accounts and you want to give it, when you finally pass, when you want to give the money to your hires or to charity, it doesn't get taxed. It doesn't get taxed at all. So that's another big advantage of investing stocks in taxable funds. Another slide I showed you before. Here's some hypothetical returns. If you invest with a professional money manager, you may get 7.2%. If you do it by yourself, you might get 8% or more. You might get 6%. If you don't know what you're doing, you could get even a lot lower than 6%. Advisors typically charge 0.5% to 1.25% of money under management. Again, Albert Einstein, compounding is the most powerful force in the universe. John Bogle, one should not let the miracle of long-term compounding of returns be overwhelmed by the tyranny of long-term compounding of costs. Niels Bohr, again, a famous Nobel Prize winning Jew, an expert is a person who has made all the mistakes that can be made in a very narrow field. So a question for anyone listening, do you want to become an expert, or do you want to let somebody who knows what they're doing manage your money? The Talmud and the Torah have a lot to say about investing. And first from the Talmud, asset allocation. Let every man divide his money into 3 parts and invest 1/3 in land, 1/3 in business, and let him keep 1/3 in reserve. That's from the Talmud. From the Torah, invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land, and that's having diversified your assets and having an emergency fund. Emergency fund is good because when you don't want to, if you run into emergency, you don't want to take out loans or have credit cards where you're paying 12 or 15% interest. And finally, from King Solomon, advice. The way of fools seems right to them, but the wise listen to advice. So that says if you really don't know what you're doing, listen to advice, hire a financial advisor. You certainly could do it on your own. A lot of it is common sense, and you'll probably be about 1% or more better. But that's only if you followed some of the advice that's in here. Plans fails for lack of counsel, but with many advisors, they succeed. And finally, I'm getting towards the end, so I'm finishing quick today. Generational wealth. The statistics about generational wealth are not encouraging. Studies conducted confirm that as much as 70% of family wealth is lost by the second generation, 90% by the third. So if you have a business, be careful. I'd recommend you teach your children, teach them early, teach them how to invest wisely. Another third found 1/3 of hires had a negative savings within 2 years of a gift. It takes an average of 19 days for a recipient of inheritance to buy a new car. In a survey, 78% feel the next generation is not financially responsible enough to handle inheritance. Their parents never talk to them about money. They don't know what to do with the money. I'm guilty, but I'm happy that my children are smart. And finally, I'm almost at the end. I want to go over the financial quiz again. We should have all the answers to these between the 3 sessions. Should you hire a financial planner advisor? You could do better if you do it on your own, but you could also do a lot worse. How much insurance do you need? Have a financial plan. Don't buy 5 times your salary or 10 times the salary. That doesn't make any sense at all. How much do you need in retirement? That's what your financial plan will tell you. What is a safe withdrawal rate? The old rule was 4%. It may be 4.5% now. I use that as a guide. I went through the slide that had 64 different cases where at 4%, you may wind up with 4 times the money you had. And in some cases, you could go broke. Should you buy stocks or stock funds? Personally, I'm not smart enough to buy stocks. I buy stock funds exclusively. I've never bought a stock. I've also a single stock. I've also never sold a stock fund that I had in a taxable account. I do all my balancing in tax deferred accounts or tax-free accounts. So where I started to buy stocks in taxable accounts, I bought first stocks as well in my tax deferred accounts. And over the years, I've turned those from stocks to bonds. And the beneficial part of it is when I sell those stocks and buy bonds, there's absolutely no taxes. Should you buy individual bonds, a total bond index fund, or high yield bonds? What we found was high yield bonds, even though they promised higher returns, over the long term don't, because a lot of those companies are not on sound financial footings, so they go bankrupt. Most of the time I bought bond index funds. In the past, I've also bought individual bonds. When my children went to school, when I was within 4 or 5 years of having educational expenses, I bought individual bonds. And I bought what was called zero coupon bonds, and I bought those to mature in the time frame when the educational expenses were due. Now, of course, 529 accounts, since if you use those for educational expenses, are not taxed at all. So that's a much better way to go. But if you have other expenses, if you know you're buying, for example, a car in 3 years, buying a bond like a zero coupon bond on the secondary market is much better than usually buying a CD. And not only that, it could be sold on the secondary market as well. If the market goes down 30%, what do? You don't sell. That's the worst time to sell. And I was reminded, I think in one of the news stories yesterday, last March, not this March, the stock market went down close to 40% in 5 weeks, but still managed to go up about 15% total in the year. So the answer is, if you could afford it, when the market goes down, that's the time to buy. But of course, it's best not to time the market at all and to be fully invested. Don't buy low and sell high because you can't time the market. What do you consider the most powerful force in the universe? Compound interest. What are the most 3 important things to investing? It's allocation, diversification, location. And of course, stay the course, don't panic. And finally, my last few graph, I have some recommended books. The first book that I ever got on investing, and it's especially good for young people, Making the Most of Your Money. It's about 1,000 pages. The appendix has great analysis for college savings, retirement savings, and the like. I highly recommend that book. And it has everything. It talks about opening up bank accounts, stockbrokers, what to look for. The other book that I would highly recommend is Common Sense Investing, a little book of Common Sense Investing by John Bogle. Anything by John Bogle is good, but particularly that one. There's a book from Bogleheads Guide to Investing. If you don't want to buy that book, most of that information is on the internet. It's in a site called bogleheads.org. I've used that extensively. It's free. You could join or not join. If you join, you could ask questions of other investors and get answers. I believe in Vanguard, which John Bogle started. There's a lot of tools on Vanguard also. And Vanguard is the king of low-cost investing. You can't do very much better than that. Looked at other sites as well. I'd also like to say that when I've made investing decisions, other decisions, and I call them investing or financial decisions, like when to take Social Security, what age, I've done spreadsheets. So the first time I did that for my wife, I decided 68 was the best time to maximize our Social Security earnings over a lifetime. By the time 68 rolled around, I decided 70 was a better time. So that's what I said. Old studies become old. It's better to redo things. If you're looking at redoing your mortgage, again, I would do a spreadsheet and say, is it worth it paying extra fees to lower your mortgage rates? Because you may never get that back over the lifetime of the loan. It may just be better to pay extra money each month and pay off your loan early. Closing costs could be very high on a loan. Now that we're about the end, I'd like to thank you all. When I retired, I had three things that I'd like to do. One was to be a financial planner, and this is probably the closest I'm going to come to that. The second was teaching bridge, and I was all set to do that before the pandemic hit. And I have one student in Dan Bender. So maybe after the pandemic is over and we could meet in person, I'd like to do that again. The third was to teach math. I volunteered to do that at Mitchell College, and they told me I couldn't do that for free. But the closest I've come to that is I've taught engineering in undergraduate school as part of my PhD assistantship. I've taught engineering in graduate school again. But my passion is math, and I'd really like to teach math at the college level. So I'd like to thank you all. And if there's any questions, I'd be sure to answer. Don't be embarrassed.
Ira,
Yes.
Ira, stop sharing your screen, and then you can see people as they ask questions.
Any questions?
Ira, I have a question. It's Helen. You were talking about taxable efficiency of the accounts. So my question is, in taxable account, did I understand it right? It's better to keep things like municipal bonds and growth stocks which could go up or down. So if there is a problem, you can harvest the losses. Am I right or not?
Yes. The first thing I would take is not regular bonds and not put those in a taxable account. The best place in a taxable account is stocks, because you get a break on the dividends that you pay. Most dividends are only taxed at 15 or 20%, depending upon your tax bracket, where ordinary income might be taxed at 20, 22, 24%. When you take money out of tax deferred accounts, whether it's dividends or anything else, those get taxed at ordinary income. There's no break for taking dividends out of tax deferred accounts.
Thank you.
Yes, Bruce.
Ira, would you be so kind to send me that last slide that you put up with the recommended books? I'd love to get a copy of that.
Sure.
Okay, thank you.
I'd be happy to do that.
Thank you.
Now, Ira, I've heard of folks in the past, even medical professionals, that love their annuities. Oh, they have several annuities and, you know, they have their income guaranteed. And yet, when I've spoken to financial people, including my long-term accountant, they were totally against it and went along with what you said, that the fees are ridiculous and it just doesn't work out well in the end. In fact, the quote from this one, again, my old long-term accountant was something like, if buying an annuity wasn't the dumbest thing you ever did, it would run a close second. So again, that's not something I've ever, really considered at all. So just going along with what you were saying.
Yes, the only annuity that I would say the only commercial annuity that I purchased was for Vanguard, and it cost me about an extra 0.2% a year in fees. But it had tax deferral, so that was worth it for me. But most annuities will cost well over 2% in fees, so that's really a loser's game. The Vanguard annuity that I bought closed about a few months ago and is no longer sold. It was sold by a company called Transamerica, which is the insurance company. Vanguard only sold it, Transamerica issued it, and it's no longer sold. Other annuities that I have, my pension is an annuity, Social Security is an annuity. Those are worth it because you're not paying fees. Any other questions?
What would you say to someone who's single and has no children about life insurance? Is it really necessary?
I would say a couple of things. Number one, if you could get it at a young age, that may be the time, because as you age and you might have children and your health declines, you may not be able to get life insurance. I know my wife had an insurance policy when she was young and single, and she bought it, I think, to make sure that if she passed away, her funeral expenses would be paid. Is that right? Yes, so that's a good reason. Or else, if you have insurance, if you have life insurance, you're just leaving your money to somebody else and it's costing you something.
Okay. Pretty much what I figured.
Anybody else?
Thank you very much, Ira. It's very informative questions.
Yes, thank you, Ira. Thank you.
Very clear,
Yep.
very clear. Just the way he teaches